For the moment, we're looking at cryptos across the board.
Crypto bear markets are scary, even for very experienced investors. I mean, they just don't feel good for anyone. You watch your once impressive portfolio dwindle into pennies, going down by 60%, 80%, or even more. We're all confronted with that horrible internal dialogue that is something like, what if this is the end of cryptocurrencies, we ask. In this video, we'll take you on a walk through the 4 biggest crypto market crashes till date. You'll see how they compare to each other and the important lessons to learn from them. Now wait a second. If you think the Terra crash is the worst crypto market crash in history, this video covers Bitcoin's over 90% crash, which is till date the worst we've ever seen. Welcome to Crypto Manual, your #1 crypto channel for informational and controversial cryptocurrency topics. If you're stopping by for the first time, please click the subscribe button, turn on the notification bell, and just wait out for newer videos. With that said, let's dive right in. What is a market crash? The word crash is definitely a popular and familiar crypto headline, given the volatility rate of cryptocurrencies. But most experts wouldn't use it to describe a mere 10% to 20% price correction, especially when there are obvious signs of likely recovery in the short term. From the very beginning, the story of cryptocurrencies has been one where a coin rises meteorically from a few pennies to tens of thousands of dollars in a very short span. This could be anywhere from months, days, or sometimes in a matter of hours. Then bam, it all comes crashing down like a house of cards. We all know that feeling. And if there's any revalue coming with that asset, the prices may recover, but if not, it just disappears into oblivion. With that in mind, our definition of what a market crash is here is, say, on a minimum of 50% price dip happening less than a month across the entire cryptocurrency market and taking several months or even up to a year to recover. With that said, here are the 4 monumental crypto market crashes we will likely never forget. Number 1, the beginning. To have a good grip of how it all started, let's go back to the very beginning. In 2009, Bitcoin was introduced as the first cryptocurrency, but the first cryptocurrency boom started with the bull run of Bitcoin in February of 2011. Before that time, Bitcoin was only worth a few pennies from July of 2010 when it was first mentioned on Slashdot, a newsreader known for its tagline, "News for Nerds, Stuff That Matters." That mention on Slashdot set the motion for what would later become the beginning of the Bitcoin boom. As Bitcoin got notable, developers got super interested in it. Later, more folks began to perceive Bitcoin as a potential game changer. Of course, the world had recently seen the catastrophic effect of the housing bubble and the dot-com bubble only a decade prior. And then came Bitcoin in the turn of the 2008 financial crisis with the promise of absolute user sovereignty and the possibility of a transparent monetary system. It proved this, at least within its own economy of users. A large majority of the earliest Bitcoin investing was mostly motivated by 3 mindsets, which are: 1, the optimism to get on board this new digital cash, which gives back absolute custody and ownership to the owner of an asset. 2, the fear of missing out on this new digital gold rush, even though it wasn't fully understood at the time. 3, cryptocurrencies made a lot of sense for illicit transactions, given it had some level of anonymity like the world has never seen up until that time. In fact, earlier cryptocurrency use cases after Bitcoin like Monero and Dash had complete user anonymity at their core. Whatever the motivation was, those earliest Bitcoin investing fueled the initial price movement, which pumped the Bitcoin volume and price. By February 10, 2011, Bitcoin had its dollar parity, meaning 1 Bitcoin was worth $1. Of course, this brought further attention to the cryptocurrency space and created that mindless buying mania we see very often today. something we call FOMO, the fear of missing out. Adding to this, another factor that drove the Bitcoin price high was an article published on the now defunct site Gawker, which described how Bitcoin was being used illegally for money laundering and drug deals. With that publication, the price grew significantly but to a less sustainable peak, and by the middle of 2011, Bitcoin had reached a high of $29.6. For some context, that was over 3.7 million percent in price movement in just a year from its listing in 2010. The first crash. The first reality check came after about 5 months of excessive Bitcoin price pump from 2011. Unfortunately, the initial push for cryptocurrencies came from illicit transactions, like we saw, amongst other things. This, of course, is unsurprising for a digital currency designed with anonymity at its core. Other worrying issues were security breaches, wallet hacks, as well as exit scams and Ponzi schemes. A notable incident to mention would be the controversial Mt. Gox hack. Mt. Gox was the biggest cryptocurrency exchange at the time of its hack. The incident reported a loss of nearly 744,000 Bitcoin, which is currently valued at over $23 billion at the time of this recording. Of course, not many companies can survive a loss of such magnitude, and unfortunately, in the case of Mt. Gox, they were unable to survive it. Although this is a controversial topic, the reality we are left with is that Mt. Gox declared bankruptcy and shut down operation in 2014 after losing 744,000 Bitcoin of users' Bitcoin holdings. These incidents contributed to the end of what seemed like an unending utopian bullish party, and eventually Bitcoin prices declined from almost $30 to an all-time low of 1 cent. If you flip the coin the other way around, it's like saying it went up by 300,000%. Just to note, this video is not particular on Bitcoin. Its recurring mention is due to its market dominance and prominence at the time. With that said, let's move on to the next crash. 2013, the billion-dollar milestone. John McAfee once said, quote, "You can't stop things like Bitcoin. It will be everywhere and the world will be readjusted. The world government will have to readjust," unquote. In 2013, Bitcoin was facing heavy institutional and government threats from every end, yet it was enjoying large-scale infamous acceptance and growth. The cryptocurrency market did not just survive the 2011 crash. In fact, it surpassed its initial all-time high of $29.6, consolidating to a new peak of $192 by October of 2013. Little did anyone know that the price of Bitcoin would soon zoom to another crucial threshold. In November of 2013, it had cracked the $1,000 resistance, soaring up to $1,154. That was over 600% price increase from its $192 all-time high in October of 2013. That year was definitely the year of cryptocurrencies, as they recorded in total a $1 billion market cap, with Bitcoin leading the pack of 13 other cryptocurrencies. Another tragic reversal. For a little backstory, the 2013 parabolic rise of cryptocurrencies began as a result of lots of demand for it, which came in from China early in October through November of 2013. According to Babin Tremblay, quotes, "The rest of the world has been buying Bitcoin to try and sell them to Chinese consumers because there's so much demand there," unquote. He further described the cryptocurrency market in China as a perfect storm because at the time, China has the highest saving rates in the world and the Chinese do not invest overseas, according to him. At least not when the real estate and stock markets are both bubbling. Well, sadly, the cryptocurrency price surge indicated didn't last a month, and yet again, almost everything went crashing down. Investors had to watch the price of Bitcoin decline by nearly 50% in mid-December 2013. This also followed Chinese ban on cryptocurrency earlier in December of 2013. The prices continued to decline relatively and gently over a little more than a year to a new bottom, recording a total of 87% decline away from the previous year's peak. Sadly, Bitcoin never saw the $1,000 mark for the next 3 years. Although Bitcoin staged different rallies to bounce back to its phenomenal peak, but all effort proved abortive, followed by dramatic falls. By January 2015, Bitcoin had crashed all the way back below $200. Remember that this video is not particular on Bitcoin. The recurring mention again is due to its market dominance and prominence at the time. The third market crash, 2017, the Great Crypto Crash. Like we saw earlier, after the crash of 2013, it took the crypto market more than 3 years to recover. And finally, in 2017, Bitcoin broke its $10,000 resistance. For the first time in the crypto market, there was a bubble, but this time it wasn't fueled by Bitcoin's price activities only. This was because before this time, many real deal cryptocurrencies with unique and meaningful use cases had begun to spring up, like Ethereum and the idea of a decentralized virtual supercomputer for deploying smart contracts. Overall, the rest of the newly minted quote-unquote alternative cryptocurrencies recorded an overall market cap of more than $6 billion, overriding the 2013 record by more than 600%. Same old story, different narrative. You may likely already know the story of how Ethereum's smart contract innovation set the stage for new concepts like ICOs, IEOs, DeFi, NFTs, and the Metaverse. For the first time, developers could easily deploy a new tokenomics along with a custom-made token for that idea and distribute them directly to the public without having to build and grow a decentralized blockchain or own a company. For the first time, startups could deploy a smart contract, sell token stocks from the idea without having to go through the traditional process of running an IPO. No supervision, no registration, just a smart contract, and millions could be raised in a matter of minutes. We all saw this happen in 2018. This possibility to raise capital so easily was only seen in the dot-com boom prior. Of course, like we all saw, the consequence for this type of leverage was wide-scale abuse by bad actors and another utopian bullish party where every idea which could be written on a white paper, however impractical, could easily raise millions of dollars if the marketing team could pull a good PR stunt. This created a speculative mania once again and another bullishness that wasn't sustainable. And as anyone would suspect, the ending wasn't good. Just after a few weeks of a steady climb, Bitcoin plunged by more than 29% and every other altcoin plummeted even further. Although the 2018 crash wasn't 100% influenced by Bitcoin this time, yet Bitcoin price, which fell below $7,000 in February of 2018 and spent the next 9 months hovering between $6,000 and $10,000, also contributed immensely. By December of 2018, the price of Bitcoin had gone down by over 83% from $20,000 to less than $3,400. Also, the entire crypto market had seen an 85% drop in market cap from $780 billion in market cap from 2018 to $120 billion in 2019. The vast majority of the ICOs and impractical projects from that period were wiped out into oblivion. And now the most recent crash, 2022. According to a Grayscale survey, over half of the current Bitcoin holders came in less than 12 months from 2022. Unfortunately, that is not the greatest welcome for new holders who joined in after 2020. However, what any early adopter will agree on is that this is all a cycle that has been proven 3 times prior over the last decade. Although sad, the reality is that a lot of things would change for the better or for worse, and it largely depends on your investment priorities and strategies. Now, for those more keenly interested in seeing a more analytic description on knowing how to spot a bullish or bearish season and knowing what to do before it begins or right in the middle of it, you'll likely find our ebook Crypto Market Bulls and Bears What to Do very helpful. Again, the link is in the description below. Now, the 10-year lessons. There are 4 lifelong lessons to pick out from this 10-year loop. Number 1 is to always have a game plan. Whether it's dollar cost averaging, value investing, income investing, or whatever traditional investing strategy you favor, having a good plan that is based on pure common sense sets you apart from the losing end of the markets by a wide margin. Lesson number 2, know when to hold. Buying and holding digital asset is not a sure bet. However, knowing when to hold might save your pocket. A basic rule of thumb to avoid this is to never let the fear of missing out or the fear of the uncertain and the unknown affect your decisions. By the way, this here is more easier if you already have a game plan coming. Number 3 is to always operate with a mentally healthy trading psychology. Your psychological state dictates the success or the failure of your trading. As much as you possibly can, do not trade with excitement or anxiety. If you've been trading strategies that get you tensed up, you might want to consider switching strategies that are more long-term oriented and less unnerving. Remember, whatever is happening today has happened in the past and most certainly would likely happen again in the future. Finally, the 4th rule. Learn how to spot undervalued and overvalued tokens. If you spot undervalued tokens, there are obviously opportunities, but for overvalued tokens, you want to stay away from those. As at the time of this recording, there are over 14,000 digital tokens listed on CoinMarketCap, with some market cap of course and trading volume. While a vast majority of those tokens are just not worth the contract fee they are minted with, less than 5% of those tokens dominate over 98% of the entire cryptocurrency market. Now, the magic with making a great investment decision is spotting these 5% token before they join the top 5%. Spotting a potential top 5% token is what separates a great investor from the pack. For reasons of being on focus, you can find a step-by-step guide on how to spot high-value tokens while they are still undervalued in our ebook Spotting 1000x Token Before It Starts Trading. Again, the link of the ebook is in the description below. I hope you found our content helpful. Thanks for staying to the end. If you found it worth your time and would love to see more videos like this one, let us know in the comment section what topics you want us to cover, and please do not forget to subscribe and turn on the notification bell so you always get our contents right on release.